you view the mix of risks here between Russia supply and the colder weather that the continent is facing?
Yeah, morning. Really good to see you. Look, we've all kind of always wished for a white Christmas, but this year around, there are challenges around it. We've already seen gas prices and electricity prices in particular go up quite substantially in the last few months, given the tightness in the European gas market. But in particular, what we've seen over the weekend is Russian gas supplies into Europe have fallen. This is because we think they are filling the second leg of Nord Stream 2 pipeline, which is not going to start till September next year, but still they need to fill the pipeline, given it's a really long one anyways. And now we do have a cold snap in Europe. I guess the silver lining for consumers is that it's still warm in Asia, so we should be able to get a few more LNG cargoes. But the weather forecasts are for a much colder than usual January in Asia. So again, those supplies could tighten up. So there is no respite for European consumers anytime soon.
Amrita, I will take that silver lining this early in the morning. We always need it. I do wonder, though, considering there is, that little bit of silver lining coming from Asia prices lower, at what level then do we start to see demand destruction?
Well, if anything, we've been calling for the requirement of demand destruction, because one of the things we are seeing, even at these gas prices, we aren't seeing enough industrial demand come off. And this is one of the reasons why gas prices keep going up. We think even at around, say, as soon as gas prices cross 80 euros per megawatt hours, between 80 and 100, you should start to see industrial demand come off, right? You need to start seeing fertilizer companies, cement, steel, reduce their gas consumption, either shut down or switch to alternatives if there's any availability. But what we've seen is they did do that initially, but then fertilizer prices have gone up, soaring higher all around the world. So these plants have restarted again. So Europe needs more demand destruction because it's too high demand between consumers. And now a lot of people are working from home again, and there's office heating, and there's a lot of industrial heating.
But Amrita, I have to wonder, if these type of prices don't cause that demand destruction, what does?
Well, but you raised such an important point, and this has been my kind of pet peeve around the whole energy transition issue, because it is a lot easier to reduce supply than it is to reduce demand. In 1980, we used fossil fuels as a whole contributed 84% of total energy demand in the world. In 2020, that percentage was exactly the same at 84%. We haven't been able to reduce fossil fuel demand. Yes, there's more gas now and less coal, but it's very difficult to change consumer behavior, especially when the alternatives are not necessarily that much cheaper.
Yeah, fair enough. I have to say, one of the remarkable things about yesterday's rally, and Javier Blas from our energy team pointed this out, that we saw January 2023 contracts in Germany surge as well. They jumped by about 90 euros per megawatt hour. What does that tell us if also the year ahead pricing is seeing such a steep increase as well? Are these structural issues that will be with us next winter as well?
Well, we've been calling for summer prices onwards next year to be rising. And, it's been a good call by the gas team, and that has been happening. The reason we've been calling for that is simply stocks in Europe currently are extremely low. If we get a cold snap, even allowing for more LNG, we will still be at record low inventory levels in Europe. And if Nord Stream 2 doesn't start up till September, we will not be able to refill stocks in the summer like we always do, which means we are going to enter winter next year with, again, extremely low stocks. And that's why you are seeing the entire gas curve move higher, not just the prompt. The summer of next year will have to move higher, and winter of next year needs to move higher, regardless of what the weather forecasts are.
And Amrita, of course, we can't have you on without talking about oil as well. We've seen the rally that oil has staged this year start to falter as we head here towards year end. Is the caution that we've seen trickle through this market warranted?
Well, I think I can understand the reasons for caution, given the Omicron variant and the uncertainties around it, whether governments are going to impose more restrictions or not. Plus, I really do believe there's a lot of year-end trading reasons behind this fall. Some of the big traders have closed out their positions, having had a very good year. Some probably got pretty badly bruised with the entire curve flattening quite a lot. So right now, liquidity is pretty much non-existent. So this is a market where even one small position here or there can really move the market a lot. So I think that's a big part of it. Of course, there are fears around the Fed tightening rates or hiking rates rather quicker. So all of those fears are playing a factor, but ultimately fundamentals just remain very, very tight. Stocks are low. Spare capacity will be going down in the coming year very sharply. So, prices should be rising, but for the next few weeks, I can totally see why prices are going to struggle unless OPEC come in and surprise.
I do wonder, though, just to what degree the market structure setup itself is bearish if we see some of the term spreads enter contango when it comes to Brent.
Absolutely. And, this has been the biggest move. Both Brent and WTI at the front were flirting with contango. Yesterday, Brent is settled in a very small contango. Look, there's not much of a difference between 20, 30 cents contango and 20, 30 cents backwardation. You're pretty indifferent. But still, we've moved from $1 backwardation to 5 cents contango. That does say something. And again, I do think it's massively positioning led. There are a few cargoes unsold in the North Sea, and that's kind of weighing on the market, because if you look at Dubai, it's still very backwardated, very much a much more fundamental market, and you can see that that demand is still very strong there. So I think it's still a very bearish sign, particularly for OPEC meeting on 4th of January. They don't want contango. And I think it's a sign that, look, at least in the short term, demand has pulled back. Refineries aren't buying. And given the uncertainty, I'm not blaming refiners for not coming in and buying crude right now.
Amrita, one question we're asking our guests here as we enter the final weeks of 2021 is the outlook for next year and the risks that lie ahead. In your view, what is the largest risk to the oil market at this point?
I think complacency is the biggest risk because we've seen, again, this is, everybody's like, oh, this is a repeat of last year. No, it's not. 50% of the world is vaccinated. Even governments you've seen, they've been quite reluctant to necessarily come out with restrictions because I think there's generally a fatigue amongst citizens as well to abide by a given vaccination rate. So we do think demand will bounce back. It might take a month or a bit, but it is going to bounce back. And we are entering next year with record low inventory levels on a forward cover basis, right? Like if you look at product stocks, gasoline, diesel, they are at 10-year lows, 20-year lows. Crude is at like multi-year lows. So there isn't a lot of buffer. You've seen Libyan outages again over the course of the last 2 days. You are literally one outage away and things can really explode higher on prices. So complacency really is your biggest risk right now.